Thousands of Uber drivers staged a strike in the US and UK, angry because they say they've been driven up a wall.
When Uber started, it was 10%, 20% that they took off each ride. Now they're taking almost close to 50%, and that's putting us in a real bind.
Uber drivers in Spain and India also held protests this year, asking for higher pay. That's increased scrutiny over how the company plans to make a profit after 10 years in the red. Uber lost $1.8 billion last year and lost $1 billion more in the first quarter of this year.
I think it's going to be tough for Uber to get out, and they might raise the money, but this could be a very difficult stock for some time.
Uber's currently building up other businesses that could make up for its ride-hailing losses. Last year, Uber booked nearly $8 billion in revenue from its food delivery service, Uber Eats. It's a market the company says could be worth nearly $800 billion. Its logistics arm is also starting to contribute. Last year, Uber got $125 million in revenue from Uber Freight. It's expanding that service to Europe this year. And the Japanese firms SoftBank, Toyota, and Denso recently invested $1 billion in Uber's autonomous vehicle venture. That technology could allow Uber to offer rides without having to pay drivers.
They're trying to say they're the Amazon of transportation. For them to execute like that and to become profitable 5 or 10 years from now, that's a long-term investment. You have to be willing to, take the ups and downs.
Analysts are now pinning their hopes on Uber CEO Dara Khosrowshahi, the former Expedia boss credited with significantly expanding the reach of the travel booking service. He joined in 2017 to address scandals that ranged from sexual harassment allegations against executives to infighting among investors. But stopping the bleeding at Uber may be his biggest challenge yet. Paolo Montecillo, TRT World.
Let's get more on Uber's prospects now. Joining us from Greenwich, Connecticut is David Levine. He's the founder of the investment firm Odin River. Welcome back to Money Talks, David. As we know, there's a bit of market volatility around because of those US-China trade tensions. What sort of impact might that have on Uber's highly hyped IPO, which will happen on Friday?
Well, it's nice to be back, Oscar. And, unfortunately for Uber, the timing isn't great, with the NASDAQ week. And, if we look at other IPOs, recent IPOs, especially Lyft, whose share price is down some 20+30% from its IPO price, it's unfortunately, the window is a little bit tighter than it was a few weeks ago for Uber. So it should weigh on shares once they begin trading publicly.
And initially, there were quite high expectations that Uber's valuation could reach as high as $120 billion. Uber itself has now sort of tempered those expectations to around 80 to 90 billion. Even so, it's a large number for a company that hasn't turned a profit. Do you think it's worth that much?
Yeah, if you look at the amount of revenues that Uber will generate in 2019, even if we're generous, it'll be around 15 billion. And right now, the company's burning about $1.5 billion in cash. So, to value the company at such a high multiple of revenues when they're not generating cash is quite, ambitious, optimistic, and I think a stretch. It shows kind of where the market has been in the private markets. As some people have said, we're talking about the long-term disruption of the automotive industry, and so over the very long run, in 10 years, when we have autonomous vehicles and that sort of thing, those are the kinds of scenarios that would require, that the industry would need to achieve in order for Uber to achieve a level of profitability to support a valuation this high. So right now, it does seem stretched, just given kind of where valuations have been in the private markets, and so especially given the market environment, the fact that expectations are coming down for the IPO makes a lot of sense. And in fact, seems likely once it starts trading publicly that the valuation might be further under pressure, just given the current environment.
Interesting. You mentioned Lyft, Uber's much smaller rival. As we know, it went public to a lot of hype in March, but as you say, the share price is now down around 27% from when it first debuted. Are you worried that something similar might happen to Uber?
It seems possible. And again, if we look at the two companies today, Lyft's valuation is still about 15 billion. The company won't generate cash for 3 years, and so that's a stretch for a company that's burning cash. And if you look at it on any kind of 4 or 5, 6, 7 year basis, you need to have quite a bit of upside. So, given Lyft's valuation has been under pressure, even if we assume that Uber has a premium to Lyft, it seems likely that this market value that we're seeing now for Lyft would weigh on on Uber's valuation on any kind of comparable basis. So I do think it gives us an indication of what's to come, for Uber as a public company. And, that's not, we have to remember the stock market is up, pretty significantly from, where things were in January. So, unfortunately, the public markets are a little bit more punishing than the private markets are for companies that go public.
So what then does Uber need to do to convince investors once it's listed to stick with the company?
Yeah, I think, again, this is like we look at 10 years in the future, which is really what this is about. I think that both of these companies are quite interesting. It's a duopoly, and it's about better optimizing the car fleet. Right now, most of people's cars aren't used, something like 70%, 80% of the time in most countries. And so, if we look around the world where cars are more fully utilized, more efficient use of fleets, and then if, we can imagine a future where there's autonomous vehicles and therefore the vehicles themselves become profitable kind of movement, become profitable to utilize a network like Uber or Lyft to kind of facilitate the movement of people. And in those futuristic scenarios, these companies could be not only bigger, meaning continue their 25, 30, 40% growth rates on the top line, but also have profitable margins. So if you look out 10 years, you could see these companies being, double the size or more in revenues, and then have profit margins that are comparable to other kinds of software platforms. But again, that's a long ways off. So in order to get to that point, I think the companies need to be disciplined as they're trying to in the near term.
Yes.
They're going to need to deal with regulators as well. And so there's some things to navigate in the short term and to kind of, push things towards that future state. It's really what they need to do. And continue to focus on that long-term direction if they want to convince investors to kind of stay through the volatility.
In the meantime, all eyes will be on the New York Stock Exchange on Friday. David Levine, thank you again for your time.